A dichotomy of retail sales reports. What does that say about the economy? This is what you need to know before the bell. Yesterday, Home Depot announced pretty dismal results. In fact, it was the worst results for Home Depot in over a decade. Today, Target coming in, reporting much better than expected earnings, and of course, holding their guidance for the rest of this year, reaffirming that guidance. How can two retail giants have such different reports, and what does that mean for the economy? Well, first thing, when we're talking about Home Depot, we have to go back in time a bit just to remember what happened with Home Depot a couple of years ago. During the pandemic shutdown, well, we couldn't go anywhere, we couldn't do anything, and supposedly we were supposed to be locked up in our houses, but if you went to a Home Depot, they were packed with people buying everything from lawnmowers to edgers to basically remodeling of their house. They were building home offices, decks, platforms, everything else around their house because, well, they couldn't leave, they were stuck at home, might as well spend those stimulus checks on refurbishing the home. Well, that pulled forward a lot of those sales for Home Depot into the past. Now, of course, with that money gone and all those upgrades done, well, we're starting to see retail sales slow for Home Depot. Target, on the other hand, is where shoppers have to go to keep up with their daily living needs, whether it's toilet paper or food or whatever it is. Target provides that lower cost tier for shoppers to maintain their current lifestyle. Again, not surprisingly, that we continue to see sales performing well at a company like Target. Walmart, Dollar General, Dollar Tree, those are going to be the stocks to watch here to tell us a lot about what the consumer is doing relative to the economic environment. A lot of people expecting this big economic downturn in the economy, yet retail sales, and especially core retail sales, continue to trend higher here as the consumer continues to go along. Now, there's certainly concerns about the ability to maintain retail sales as credit lending standards continue to tighten. Now, there is a correlation, obviously, as credit standards tighten, that retail sales decline because, well, consumers can't get access to more debt, right? And this is a debt-driven economy, of course, and that's going to lead to slower retail sales in the future. And that's what that data suggests, but we're not there just yet. And again, this idea of a big economic downturn, this huge contraction in retail spending, isn't showing up in the data yet. Right now, we're tracking a 2.6% growth rate in the second quarter for the economy. So even if we get a downturn in the economy later this year, that doesn't necessarily mean that we're going to be in a deep recessionary environment. So again, it's always important to keep these things in perspective, particularly when it comes back to the financial markets and investing in the markets. Market continues to do nothing here. We've just been stuck, everybody waiting to get this debt ceiling deal behind us. But pay attention to retail sales. Retail sales make up 40% of personal consumption expenditures, which makes up 70% of GDP. So as long as retail sales continue to hang in here, that suggests that, again, the market has some stability here, and this idea of a deep economic and financial market contraction is not in the cards in the near term, at least not right now. We'll continue to watch the data, report back to you, but I'm your host, Lance Roberts, and that's what you need to know before the bell.